Morning guys, Joel Frank here, market analyst for YouTrading, and this morning we're taking a quick look at the S&P 500 and some of the fundamentals and technicals that are going on with this asset class. Before we look at anything else in terms of like the short-term stuff, let's just quickly recap what's been going on with this index over the last couple of months. Let's go right back to before the pandemic. As you can see, we had this massive pullback. That was like a 40% pullback at the time. That was last February going into the March. But since then, we've had this colossal, just absolutely ridiculous recovery all the way back from lows. Where were those lows again? Those lows were, literally under 2,200 in the S&P 500, all the way back to current levels, which are, of course, all-time highs that we are currently at. And that's around 4,200, so nearly a 100% gain for the S&P 500 in the last sort of 14 months or so. So very, very impressive. And if we zoom in a little bit more now, you can see we're pretty well supported at the moment, just below those previous all-time high levels. You can see that the all-time high that we're kind of struggling to get through at the moment, but we're close to, was set back early last month, and it looks as though we're kind of just consolidating really, and market participants are weighing up whether they want to push through this level, which is around 4,240, or we want to continue to range within this recent range. I mean, the bottom of that recent range, last month's range, was just above 4,000. And you can see just to the downside, we do have some support, which if you look back has actually come into play on a few occasions over the last couple of weeks. And that support comes in the form of the orange line, which is the 21-day moving average, and the green line, which is the 50-day moving average. And obviously looking back, you can see that both of them have been decent support. Like, that was good support. The 21 DMA was good support last week. The 50 DMAs were good earlier on last month. And then before that, the 21 DMA, decent support. Broadly speaking, with equity markets, the moral of the story of the last year has very much been to buy the dip. If you weren't buying the dip, or God forbid, if you were going short and trying to, ride look for a pullback, like a 10% or 20% pullback, you got burnt. So I think, obviously, what do they always say? Trade what you see. And what have we seen time and time again? It has been buying the dip. So just from a technical perspective, in terms of the trend being your friend, if you know what I mean, a potential trade that might sort of materialize is if we do see a little break above this previous all-time high, and then a potential pullback towards that level, which might see a reload of some longs, or potentially if the pullback is a little bit deeper and we go back to these moving averages, and then potentially I can't move that arrow, let's do a new one, and then potentially another reload of some longs to push on. So that would be following the recent pattern. Fundamentally speaking, okay, do the fundamentals support a continued gradual rise in the S&P 500? Well, you'd have to say at the moment it seems as though they do. For example, the most recent US labour market data last Friday wasn't great, was a little bit weaker than expected. It was I think expectations were for 650,000 jobs to be added to the US economy in the month of May. It was less than 600,000 jobs that were added. So it means that the jobs market isn't super hot and putting pressure on the Fed to start pivoting towards the easing of its bond buying program. But equally, the data did still signal that the US economy and the labour market is heading in the right direction. So a lot of people saw that data as very much Goldilocks. Goldilocks is the word you're probably going to hear quite a lot going forward. Not too good data that it gets the market worried about central bank tightening, but also not so bad that it gets people worried that the economic recovery is not on track, okay? And can we continue to stay in this Goldilocks situation in the coming months? I mean, it seems likely to me. I see no reason why there should be a drastic slowdown in the US economic recovery. The country is reopening. Unemployment benefits are being wound down. Unless there's like a massive resurgence in coronavirus infections driven by a vaccine-resistant new strain or something, things should continue to head in the right direction. That being said, if things continue at the current pace, which has been a little bit slower than we expected a couple of months ago, that should be good enough to keep the Fed patient and dovish. And obviously, accommodative central bank policy has been a key pillar of this rally over the last year. And going forward, I think expectations that the recovery will be good, but not too good, and that will keep the Fed sweet, and with their easy monetary policy, that is likely to keep these markets supported. I mean, I think probably the biggest concern for stocks, for the S&P 500, is probably just the fact that there hasn't actually been a meaningful pullback, like a 10% pullback, for example, in a very, very long time, and perhaps one is overdue. That is something that has been getting investors a little bit worried. But other than that, the fundamentals look definitely very positive. The technicals look very positive. So yeah, that's my take on the S&P 500, guys. Hope you enjoyed the video, and I'll see you all in the next one.